Hello, welcome to the How to Read Candlesticks and Basic Patterns video. This video is going to help explain to those of you who are newer traders what a candlestick is, what that means when it prints, and how to identify very basic patterns that you will see frequently in the market. Candle reading is something that I personally love to do and many people find helpful. I will just preference this with a disclaimer before we get into the course that candle reading alone I do not think is enough for you guys to trade solely off of. There are people who do it, but as a beginner I would look to use that as a confluence and not the sole reason as to why you would enter into a trade. So please be careful when you are taking these trades. Don't just see one pattern and think that that's enough to enter in. You would want to see the pattern or a specific style candle, and then also another confluence that would help to strengthen the analysis as to why you would enter into that trade. So for those of you who are brand new to trading, most people use the Japanese candlesticks, which are formed by time. Each candle is formed by a set time. So when you see things like 1 minute, 3 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, those time frames that you're seeing on your chart, when you are clicking on one of those time frames, so say hypothetically we clicked on the 5 minute time frame, that would mean that each candle that prints is 5 minutes worth of time. It took 5 minutes for that candle to completely form from open to close. You will most likely see red and green candles on your charts when you're beginning. You don't, unless you change the colors of them. That is optional for you to do as you get more advanced. But to start, you will see red and green candles. When you are looking at a green candle, a solid green candle, like the one here on the screen, that would mean that this is a bullish candle. That means there are buyers in the market and the market is looking to push up in price. When you see a strong red candle, like the one on the screen here to the right, that would be considered a bearish candle. When you see a bearish candle, that means that selling pressure is now in the market and that the price has come down. So just remember, green is buying and red is selling when you see those kind of candles. Green means bullish, red means bearish. Basically, what this means is that the bullish candle shows that the price has increased over the period of time that it has been forming. That would mean that in this example of this candle, over the course of 5 minutes, the price has increased if it closes green. Opposite would be bearish, so the candle would show red, and that would mean that the price has decreased over that period of time. There are a couple of different parts to identify on candles. Most important part that you guys need to understand as beginners is what we refer to as the real body. That's the fat rectangular part of the candle that you guys are seeing here on the screen. This is known as the real body. The real body is formed as price is moving during that designated time period. So from where the price opens and closes. This will work is that in a bullish example, in the green candle example, price is opening down below. So if you look down in this area here, this is the highest point that price reached during that time period and then the lowest point. But once again, price opened here at the actual body formation of the candle and then closed down here at the bottom of the body formation. Just to show you guys one more time, like the basics of what I just discussed there, the real body, those are the actual opening and closing prices. If it is bullish, you are opening low and closing high. If it is bearish, you are opening high and closing low. And the wicks that you will see coming off of the candles that will come out of each end, those are just testing of price areas, but not the official open and close. So besides seeing a bullish or a bearish candle, the other candle that you will identify on a chart quite frequently is a doji candle. Doji candles are just kind of like neutral candles. There are dojis that mean a lot of things. There's lots of different types. You can get into an entire doji candle reading course. But to keep this simplified, when you see dojis, most of the time they will identify a neutral type of trend, potentially a reversal in some situations. I will show you that in a couple of slides where you would identify them as like a reversal symbol. But the overall concept of seeing dojis is kind of a neutral idea. Basically, what it means is that the price has opened and closed at the same or very near to the same price. And there is very little body. So there's not enough body to really decide whether it was a bullish or a bearish candle. It's just kind of neutral. That means the selling pressure and the buying pressure were about equal to one another. So as you nothing here, if they printed back to back, that would tell me to go one way or another. This is why you would want to wait a couple more candles afterwards to identify who truly has control. Okay, so I just explained to you guys the three basic candles you'll see. You'll see a bullish candle, the big green ones. You will see a bearish candle, red ones. Or you will see a doji, a neutral sign of indecision where it's just kind of a lot of wicks and a very small crossing body. Now that you understand those three, it's important to understand the very basic chart patterns that they can form and what do those patterns mean when you see them. There are tons and tons of candlestick patterns. You will drive yourselves insane trying to memorize them all. But I'm going to go through a few of the most common ones that when you see them, they are well tested, they are well proven that they work. And when you see them, you should go like, oh, that's this pattern. And you should be interested in looking at finding another confluence to trade in the correct direction with that candle pattern. So I'm going to show you first the bullish common patterns that we will see. Then I will show you bearish, then I will show you neutral ones. So that way you can kind of keep them separated in your head. So after the market has done a bearish move, meaning it has fallen, price has fallen down, it is common to start seeing bullish candlestick patterns start to form because the market can only trend in one direction for so long. So I'm going to show you some of these bullish candlestick patterns that are pretty common and that will be easy for you to spot in the market. Bullish engulfing is a very simple candle pattern. This is identified by two candles side by side. You can see them circled there on the bottom. It would entail having one smaller bearish candle and one engulfing stronger bullish candle. So as you can see, the green candle is engulfing the smaller bearish candle. This will happen after a strong downtrend. So as you can see, the market has fallen and these are bigger candles showing good strength in the market. Then you're getting some pushback here by buyers. You get another little push down by the sellers and a smaller candle here for the sellers. This candle is signaling that momentum and strength in that direction is starting to slow down, and then it is met by a strong engulfing candle of the opposite, meaning that the buyers have now engulfed what the sellers are doing and are looking to push the price back up. So this would be a pattern that would be common to see when you are looking for a potential buy after seeing a selling market. Another common bullish candlestick pattern would be the hammer. I touched on this quickly when I was talking about wicks, but again, you would see a strong bearish market falling down, then starting to see some dying of momentum, and one last strong push by the bears, which would be this wick, where they were pushing that price down, trying to push, but the bullish market, the buyers said no way, and that's what creates this wick. They have the actual candle closed here when we're talking about the real body of the candle, meaning that all of this wick that was formed was all a giant rejection of every single price that would have been all along here. So the buyers have now stepped in, said that is enough, bears, like that's enough, too far down with the price. They're stepping in, rejecting all of these price points and getting ready to help push the price back up. So that would be a hammer. An inverse hammer is the opposite of what I just showed you. So a strong wick at the top, but it would be followed with 3 candles. So instead of just 1 candle, you're going to see 3, where you will see a bearish candle that forms, pushing price down, creates a hammer here where they did try to, again, the sellers are trying to push down, but the buyers were like, nope. And they tried to push up, and the bears and buyers are basically just fighting all along this wick here. But the idea is that it does still close as a bullish now candle, meaning buyers have taken control, and then they will form this 3rd candle, which helps to create the entire inverse hammer pattern. And this 3rd candle is what we see as a strong bullish candle, and they are now going to look to potentially take over the market. A bullish piercing pattern is another common one that you will see. Basically, what you will have is a strong bearish candle pushing down, and then the next candle will come up and fill 50% of that previous candle. And when it fills to at least 50% of that previous candle, and the gap that it leaves between the first candle and the next candle is smaller than what the candle has filled of the previous candle, this can be considered a piercing pattern. So basically what this is showing is that when the bears came in, they were trying to push this candle down. The sellers wanted the price down, and they were able to, on the next candle, push the price down a little bit more. But when it came to actually getting the price down, it did not happen. The bulls, the buyers, then stepped in at this point when price was gapping in here and said, no way. And they decided to push this price up even stronger. And it covering more than 50% of that previous strong candle from the bears, meaning that they have now gained enough strength and momentum to potentially push the market in a reversal. Morningstar is a pattern that I find a lot of people really like, this Morningstar pattern. However, it does take quite a few candles for it to form, which I think is why it is quite popular when it comes to identifying this. It's multiple candles giving you that stronger confluence, and it is a little bit easier to spot. Essentially, what you're having with a Morningstar pattern is that the bears have dropped the market. As you can see, the market drops down, and then you get a very tiny candle here, similar to almost like a doji-like candle where there isn't much happening as far as the body goes. It's a very small body showing very low momentum. Even though there was some strong movements before, usually this is like you've just gone too far, too much, and the buyers are now saying, no way. They will meet it with a strong candle pushing back up. So almost engulfing, but not quite. It's a little bit stronger than an engulfing candle at this point. So that is what you're seeing here. So at this point, you would assume that the direction is potentially going to reverse and the buyers will take control of the market. 3 white soldiers is a common pattern you'll see. 3 really strong bullish candles all in a row. So you have a fall of the market here and a downtrend. 3 very strong bullish candles. There is no pushback at all from the bearish market. You can see everyone is strong green and closing with very little wick, meaning that the buyers were very convinced in forming that price. The real body is strong and no rejection of price anywhere with wicks, really. That's 3 white soldiers, and that is showing a very strong push and change in momentum and volume in a opposite direction. Tweezer bottom is another thing you will see, where you will have 2 of the opposing color candles next to one another. So in this example for a bullish, you would be looking at a bearish strong candle, hits the same price point here, and then opening of the bullish candle is at where the close was of the bearish opening, and then it literally matches it in size and strength and will close about the same. They usually equal one another as far as opening and closing price, and the wicks, if they do have them, will test the same price area. So it's like twins. You know, a bear is pushing down and then the bulls come in and say, nope, not happening. We are matching you and we are here and present. So this would be something where you would also potentially look for a reversal. And lastly, the bullish pin bar is something that you will see a lot. Also similar to having a very strong rejection wick. As you can see here, the tail is 2 times the length of the real body. That means that the rejection that they tried to push. So the bears are trying to push, sell price. And the bulls said, heck no, like we are pushing you up, like absolutely not going that low. And they end up letting it close very small, the body. So lots of pressure and indecision happening here while this wick is forming. And that is a big sign when you have a rejection wick of all of these price points that potentially a reversal is coming. So a pin bar could also signal a potential bullish reversal. So now I'm going to show you guys common bearish candlestick patterns, meaning that the market is potentially about to start selling off, that the bears will take over control, and the patterns that you would see commonly happening prior to a bearish market starting. Like the bullish engulfing candle, there is a bearish engulfing candle. Essentially what that means is that you would have pressure from buyers pushing it up, and then you would have a kind of consolidation period where you can see that the momentum in the candles, the strength of them, starts to fade off. You would have a bullish candle. So this candle closes as a bullish candle here. A little bit of a push from them to try, but then the bears come in very strongly and engulf this previous bullish candle. So this would create the bearish engulfing candle. As you can see, there's so much strength and momentum in this bearish candle, showing that the bears have now arrived and are ready to go and push this market down. A lot of times what you will see is it will break the area of consolidation. As you can see where all of these candles are kind of hovering at, usually the engulfing candle will break through that area as well and start pushing the market down. So this could be a potential key to looking at a reversal market or a bearish market coming after a bullish uptrend. The hanging man is essentially the opposite of what you have seen when it came to a bullish market. It kind of looks like the inverted hammer. So this would be where you are having, again, a strong uptrend in the market. The bulls are trying to push the market up. And the bears, you can see where this wick is forming, lots of pressure from sellers coming in. This is basically showing that the bulls are still trying to rally. They're still trying to keep control and gain it, but there is a lot of pressure coming through from the bears in this rejection wick. This will signal to a lot of traders who are interested in getting in at a better price or potentially getting in early on in a reversal that they may start being a lot of pressure coming in now from the bears. So people will look for this candle and jump in quickly sometimes. This could be a potential direction change if you saw this candle. A shooting star is where you will have a lot of pressure coming up. They shoot the price up. So think of it like market is shooting up. The bulls are pushing really hard with this, and the bears come in and say, absolutely not. They are rejecting this all along in this price, and they create basically what looks like an inverse hammer situation. So you would have this little body that closes down here, and it would close bearish, showing that the bears have now said, absolutely not, rejected all of this price point and have decided to close here, showing that the bulls have very little control and the bears are about to step in. Evening star is the opposite of morning star. Morning star, think of it like the market may potentially go up because in the morning the sun goes up. That's how I like to think of it, and the sun is a star. An evening star, the market may potentially go down, and in the evening, the sun goes down. So that's how I try to keep them straight in my head. Maybe that'll help you guys. Evening star is a 3-candle pattern that you will see, the opposite of what the morning star is. You will have a strong uptrend. You will have a strong bullish candle. Then you will have a strong bearish candle. Sandwiched between those two will almost be like a neutral looking doji style candle where you can see a lot of indecision, which is what you're seeing with this candle. It pushed up, it pushed down, not very clear as to who actually has control over the market. And usually this will happen at like a key area of where price kind of is meeting some sort of resistance sometimes. So if you see it hitting a key area of resistance and you see a evening star pattern form, you would potentially be looking to take a sell or a bearish trend to start forming. Like we saw on the bullish side, there was a piercing pattern. There is also a bearish piercing pattern. Same concept here, but flipped. So you would have a strong bullish candle that prints, and then it is met with an extremely strong bearish candle that is accounting for 50% of that movement that the previous candle made from the opposite market, meaning that the buyers were pushing the price up very strong, but the sellers came in and said, no way. They had been able to push the price back down at least 50% or more of what the buyers were able to accomplish. So if you see this, that would be a signal potentially that a reversal is coming, and just showing that basically the gap would also be less than what they were able to cover. So where the market price closed here and was able to push up and gap up, this gap in between the two is less than what the progress of what the bears had made in dropping the price. So if the gap is smaller, as well as it accounts for more than 50% of the previous candle, you would be looking at a bearish piercing pattern and potentially look for sells. 3 black crows is the opposite of the 3 white soldiers. So you would look for this pattern after a uptrend. You would see it form when you have 3 strong bearish candles, all opening and closing at a lower price than the previous candle. So you can see you have a strong bearish candle, closes here. The next one opens at that price, closes lower with no retracement. Again, price is here, it is closing at this point, and this candle is opening, very little retracement of this wick, and closes all the way down here. Lots of strength, lots of momentum. That is what that is signaling. This could signify a potential reversal, just showing a massive momentum and strength in the opposite direction now. Tweezer bumps you will see happen often at a point of resistance, so you will see a bullish trend, pushing up, hitting most likely a key level of resistance or price. So those of you who like support and resistance or price action trading or zones, you could look for some sort of tweezer top or bottom happening at a key level. Basically, the twin concept again happens here, where you would have a tweezer top formed after a bullish trend. It is saying that the bulls are pushing up, hitting a key level, and the bears are like, absolutely not. Too close to this key level, too expensive. We already know this price doesn't work. And they come in and say, we're going to sell. We want to sell at this area. When it hits that price, we know it's too much. We want to put in the selling pressure. So they meet it with an equal candle of equal strength, equal volume, showing very equal presence of them in the market. And at a key level, that could be a potential reversal that you would see happening, showing they're aware what's going on, they're present now, and they're going to drop that price. There are pin bars that happen for bearish markets as well. So like we saw in the bullish version, it would be an extremely long wick, at least 2 times. So the tail, the wick or tail, would be 2 times the size of the actual body, showing massive rejection. So showing super strength from the bulls trying to push. So at some point they got the price this high, but extreme rejection from the bears, saying absolutely not happening. So when you see this, you could also potentially assume that the bears are well aware that this price isn't going to work and they want to push down, and they are now interested. Many times after a pin bar like this, you will get a strong bearish candle that will form, and that is your key to then get in. So now I'm going to show you guys a couple of common continuation candlestick patterns. The idea of these are they kind of fall into this like neutral zone, and if they're neutral candles, it doesn't mean you need to look for a reversal or you need to close out your trades. Sometimes they're just signaling that you're kind of like in an area of consolidation, or that the pattern will continue on because there's no definitive direction right now. So don't panic and close your trades. You can still hold your trade. So what you'll see here is the dojis. Like I said, the doji has a couple of different ways it can be identified. The overall concept of dojis is that they are a neutral candle typically. However, there are cases where the dojis kind of look more like those hammers or inversed hammers, like I was showing you guys, almost like a pin bar even. So in those cases, as you can see on the outer red and green candle dojis here that look similar to the hammer and the pin bar that I showed, those would not be considered continuation candles. Those could be considered potential reversal candles in the right situation. However, the dojis that are in the middle, where you have more of a cross-like figure, where it is similar wicks on each end and the bodies are small and they are in the middle, those would be considered continuation, where they're neutral. The buyers and the sellers are kind of closing around the same place. There's no real strength decided in either of these candles. So you wouldn't really care about those. If those printed, you could look to continue trading in the same direction if a doji prints like that. If one of the dojis on the outer circle print, you would look at those as a potential issue, and you would want to think about where would they fit in one of those bullish or bearish patterns that I showed you. Spinning tops is another potential that you will see for a continuation. They do kind of look like tops, like the little toys. And you can see, once again, a very neutral candle. Closes in the middle. The wicks are about the same length from the top and the bottom. And there's no real decision as to who has actual control here. The bears and the bulls are meeting in the middle, and they're about the same when it comes to strength. So if you were in a trade and you saw something like this print, it wouldn't mean that you need to stress about a rejection wick or anything like that. It is equally rejecting on both ends. So you could continue to hold your trade with a candle like this. The falling three method, also sometimes called the three-line strike, is something that very commonly gets confused when it comes to three black crows or the three white soldiers. So please make sure that you are paying attention to this if you plan to trade that pattern. The falling three is different. It is three very strong candles of the same color in the opposite direction. However, they do not surpass the previous strength of the overall trend. So let me explain this. You have a falling market here. You have a strong bearish candle. Then you have three bullish candles that are trying to push up. But they are not opening and closing above one another. They are pushing up, and they did not surpass the previous candle. They did not overtake this price. They are retracing this massive move. So the bulls are coming in to make some accountability for how fast this price dropped by the bears. But they did not overtake the price by beating the price here. They did not show super momentum by opening and closing above one another like we did with the three black crows and the three white soldiers. They did not overtake the progress that the bears have made. So don't get yourselves confused with this. This is just a small retracement to get the price a little bit higher, and then more bears become interested because they can now buy in at a better price and drop it again. So instead of having to buy in low down here and missing this whole movement, the bulls will push the price a little bit to try and rally it a bit. They fail to do it, and the rest of the bears that missed this drop are very interested now. They will come in and drop that price. So this is something you guys should be cautious of. If you're confused by the falling three method, please don't worry about it until you're a little more advanced with it. But this is also referred to, I think, by Artie as the three-line strike that he likes. So it can be deadly if done right. You can get in at a great price, but please be cautious with it and do not confuse it with the three black crows or the three white soldiers. The rising three is the opposite. That would be if you're looking at it from a bullish trend point of view. So meaning the market is going up. The bulls are in the market. They're pushing it up. And then again, you have three strong bearish candles. They fail to overtake the progress though. They never go below the progress of what the bulls have done. And the opening and closing prices aren't quite as strong as they would need to be a three black crow or a three white soldier. And you can see they just retracing this bigger movement, get you in at a better price so you can buy a little bit lower now. And all the people who want to buy are always looking for a sale. They're like, cool, the price just went on sale. And they get the price they want here and push the market back up. Okay, so you guys have become candle connoisseurs now. You have finished this course with candle reading and knowing the basics. You have learned the basic of a bullish candle, a bearish candle, and a doji, and the very basic bullish, bearish, and continuation patterns that you can find. There are thousands of them, guys. I promise you there are so many your head will spin. But to get you started, this is what you need to know. We will give you a PFD that you guys can download. I highly suggest that you print out the PFD and attach it to your computer or to wherever you trade, just to have it as a reference while you are still learning these patterns. My last tip for you guys is that as you're journaling your trades throughout the week, if you are using something that is more rule-based where you haven't really gotten into the technical analysis side of things, and you haven't really given too much thought to this, that you do actually do that. Start journaling your trades and go back at the end of the week, even with your rule-based strategies. See if there was a pattern that could have helped you, that maybe you identified and were like, wow, I should have actually done a reversal here and not bought there. Or, oh, there was a continuation. I could have held that trade longer. Those are the things that will help you start to critically think and really hone in on your actual trading skills, where you can start analyzing charts and becoming the most proficient trader that you can be. As always, guys, if you have any questions, please feel free to reach out to us and we will be happy to help you. And thank you for watching.